Hi there and welcome to ET Now. I'm Ashwin Mohan and welcome to this special edition where we're going to discuss some of the major concerns that have been raised in the capital markets based on some of the public statements made by Prime Minister Narendra Modi and of course the immediate clarification that came in the very next day from Finance Minister Arun Jaitley. The discussion will of course be from the perspective of what can be expected from a capital markets perspective in Budget 2017, and joining me to throw more light on that issue, we have three leading lights from the world of tax: Daksha Baxi from Khaitan Co, Punit Shah from Dhruva Advisors, and Amrish Shah from EY. To all of you, thank you so much for taking out time and joining me on this special show. Daksha, let's kickstart with you and let's look at the exact statement made by Prime Minister Narendra Modi recently to a house full of capital markets participants as well as leading CEOs. He said, and I quote, "Those who profit from financial markets must make a fair contribution to nation building through taxes. For various reasons, the contribution of taxes from those who make money on the markets has been low. To some extent, it may be due to illegal activities and fraud." Now, Daksha, this is probably the first time that Prime Minister Narendra Modi, within a month or so from the Budget 2017, which everybody is eagerly looking forward to, has directly raised a concern that market participants are not coughing up adequate taxes. Now, even though there was a clarification from the FM the very next day that this does not mean that there will be an introduction of long-term capital gains tax, what do you make of the timing?
Well, indeed, the timing is, I would say, opportune as well as rather unfortunate. I do respect a lot of measures taken by the Prime Minister, but I think here there is some amiss. Capital markets, let's understand how capital markets work. Capital markets is the largest platform which provides low-cost funding to companies and businesses. Of course, the secondary markets mean that people are making money, but what is their investment? Their investment is risk money, and it is only the reward for the risk that they get. Just as they make money, they also lose money. So it's not that always the people who invest in capital markets are making money. When they make money and they don't pay, it is being seen. But when they lose money, they don't get any benefit out of it. Who gets to see that?
So do you think Prime Minister Modi's statement can be safely assumed to be an early warning that there might be some tightening regarding tax policy relating to capital markets in the budget?
I would imagine, I think it is more referring to some illegal activities rather than the plain and simple capital markets industry.
All right, Daksha, hold on to your thoughts over there. Puneet, do you concur with Daksha that it's more to do with the illegal activities and perhaps the tax community and maybe even the media is playing this up a little more than what it should be?
It could be for illegal activities or whatever reference Prime Minister has made. But the consequence would be borne by everybody. I mean, the issue would be that you cannot have separate tax rates for a particular activity, because all the trading or all the gains which would be earned on the stock market, whether long term or short term, will have to be taxed at a particular rate. So all the activities would be impacted, not only legal, but not only illegal, but even legal activities will be impacted. So that's number one. Second, the timing, yes, I agree. Just a month before the budget, clearly there are some signs being given as to what's in store and what's coming. Of course, Finance Minister has immediately clarified that such a thing is not in store, and is very, very emphatic to say that long-term capital gains, there is no proposal to tax long-term capital gains. So I think that was a bit assuring. But the third point is that Finance Minister's roadmap on reducing taxes, which is more on corporate taxes and personal taxes, is something which is laid out, but there is no roadmap for the capital gains taxes.
Absolutely, and that's where I want to extend your thought and bring the next question to Amrish. Amrish, so let's look at a situation. Clear cut, Finance Minister has said we are not planning to impose any long-term capital gains tax, so please don't get nervous. That's the message from the government. Now let me link the current situation to what happened in last year's budget. In last year's budget, the minimum holding period for unlisted securities was in fact increased to 2 years. Do you think the government might use this as an excuse to extend this rule to listed stocks this year? So could we perhaps see a longer holding period for you to be eligible for long-term capital gains tax eligibility as compared perhaps to a situation wherein the exemption goes ahead, is taken off?
So I think if you just step back and first look at the statement and all of that, clearly is giving some pre-warning. And if you look at the trend that has happened, including the demonetization, there were clear warnings prior to that. So something is coming. I think that's a given. The issue is what is coming. Will it be a 2-year period for long-term capital gains? Will it be some other manner of dissecting and bisecting how to gain more from the capital markets? And there could be different ways of looking at it. I think paramount for him will be whatever he does should not create confusion, and India should not drop down from the ease of doing business parameter perspective. I think that's something which they will have to keep in mind while framing whatever.
It has to be consistent with all his other publicly announced policies.
And the other factor here is that how will he apply, even if you were to say apply a long-term capital gains, let's say 2 years, just for this purpose.
Over and above the current 1 year. So extend
1 to 1.
Extend
1
the
plus 1.
eligibility from 1 year to 2 years.
So
in a bid to encourage long-term investors.
No. So can somebody tomorrow come back and say this is nothing but retrospective taxation? Because I bought it in April of 2016, assuming I'll get out in May of 2017 or maybe July of 2017. Now on all those investments,
that's the risk.
That's the risk. Somebody will come back and say this government said they will not do retrospective taxation, or will it say like everything else, like what they did with the Mauritius Treaty, April 117, any investment thereafter will need a 2-year period. I think something like that needs to come out.
So do you think he will tinker with the eligibility period for long-term capital gains tax? Yes or no, before I move on to Daksha?
I would think so. He would do something, because having given some hint, and if you look at both the statements that they're not going to take away the exemption, this seems to be a given thing.
Daksha, do you think he'll take the plunge in this regard?
Well, he may do that. He may also do something else with short-term capital gains. Short-term capital gains are if the transaction is done on stock market and STT is paid, it's taxed at 15%. But if you make a loss on short-term gains, you can actually set it off against your other income as well, just as any capital loss can be set off. So he may disallow that loss to be set off against any other income,
sure,
but only against a short-term capital gain derived from the capital markets transaction. So that is also another way of increasing the ability to draw more taxes while not hurting the capital markets.
It fits in with the direction that has been indicated by the PM.
Yes.
Punit,
Yes.
what's your analysis? Long-term capital gains tax exemption, short-term capital gains tax exemption. If you look at the current scenario, where do you think the chances are more for there to be changes in the budget?
See, my view is, I think this creates a problem on disstability as well. Today, there has been this regime for several years, long-term capital gains not taxable at all, listed long-term, short-term capital gains tax 15%.
And maybe hence the warning. So therefore, there is less disstability.
Understand, but in 1 month is not good enough in that sense. The point is that the regime has to be stable. That has been the request by the investors, the foreign investors, the domestic investors. And if you keep on tinkering with the regime again and again, then as Amrish also said, it could result into a retrospective taxation. It could result into several investors unable to plan the long-term strategy for India. Look at dividend distribution tax, for example. Now it's there for several years. It has worked well and it's not taxable in the hands of the shareholders. So again, what is important is stability, certainty and predictability.
Do you expect him, the FM, that is, to make a change in this regard in the budget?
So to my mind,
going by the current indications.
to my mind, yes, something may come. Difficult to predict, obviously, in terms of whether it will be increase in the holding period to 2 years, whether it will be change in the short-term capital gains tax, that is also possible. And the third could be STT itself, whether STT rate could change.
We'll go on to STT,
Sure.
But before we move on to STT, it's clear that all three of you do expect
Yes.
some changes in this regard in the budget. Now, Amrish, hold on to your thoughts, because I want to quickly examine one more statement before we move on to other capital market related aspects, and that is, the Prime Minister also went on to add that to some extent, this low contribution may be due to illegal activities and fraud, and therefore SEBI needs to play a more wider role and be a little more vigilant. And to some extent, the low contribution of taxes may also be due to the structure of our tax laws. Now, that's a clear giveaway that there might be some changes in the structure in Budget 2017. Low or zero tax rate is given to certain types of financial income. Now, my specific question to you, Amrish, is what are the types of financial income relating to the markets which currently have low or absolutely no tax, and which could possibly come under the lens of the government in a bid to get more money from the capital markets?
So if you see, I think obviously listed securities is the biggest of the beneficiary if you have held it for more than 1 year. I think that's the primary one. Apart from that, if you were to then go back and say, why short term at only 15%? Why not 33, the normal tax rate? If you were an unlisted security for short term, you would have gone through that rate. There is still a dichotomy between an Indian corporate and a foreign company, because an Indian corporate will still end up paying a MAT tax at 20%. And can he go to the reverse and say that no, now I'll have 20% as the short term capital gain, because then I'm equating a foreign company vis-a-vis a local Indian company. And I think that's something that will come in for play, to my mind.
Daksha, would you like to add to that? What are the types of financial income that currently attract low or no taxes relating to the capital market specifically that might be looked at? Because this is clearly looking like an attempt to plug the loopholes and get and not be as relaxed as the regime was earlier.
Well, even the debt instruments, for example,
sure, yeah,
they are also exempt if they are held for more than 1 year. Because they are also dealt with on the stock exchange, STTs paid, etc., etc. So it is quite possible that there will be some change in respect of that, because debt does need to be for a longer period of time if actually the benefit of the debt investment is to be reaped by the people who have got the investment. So from that perspective, maybe that would also be changed. In fact, I would probably even go to our Mauritius Treaty and Singapore Treaty with regard to that, but I would hold my thought on that because I'm sure you want to come back to that.
I will come back to the treaties.
But it is certainly something, debt investment is something which can be impacted by this.
So there is a case to be made. All right, Punit, you have lots of foreign investors, funds as your clients. What's been their reaction since the PM statement and the immediate denial by the FM saying that the media has misread the statement?
I mean, you'll have to look at several events which has been happening. This month has not been particularly good for the FIIs or FPIs making investments in India. You had a CBDT circular last week, which again gave a lot of clarifications which are not to the likings of foreign investors or funds who are making.
But specifically relating to this, what's been the response from your clients?
And coming to this,
have there been anxious calls?
There are, definitely there are. Obviously, the finance minister immediately came back with a clarification, and therefore damage, so to say, has been curtailed to some or contained to some extent. But everybody is trying to interpret what the Prime Minister meant by the profit being earned from India. I see value is being created in India. Clearly, nobody can deny that. This market has been more buoyant as compared to some of the Western markets or developed countries markets, and a lot of gains have been made. Nobody can deny that fact. So
I think the fear factor is because of the wide gamut of transactions that come under this category, profits made from markets.
Absolutely.
Right?
And therefore,
I think that's where the fear factor
and
is.
Therefore,
even derivatives.
Correct. And therefore, whether derivatives would be 80 to 90% of the markets today in terms of the volumes. And therefore, whether these gains should be subject to tax or not is definitely a matter of debate. Several developed countries do not charge any capital gains tax at all. Whether it's US, whether it's Singapore, they do not charge any tax on the capital market transactions. But India, is always a balance between depth of the capital markets and the tax revenues you need for your country.
Absolutely. When you're in Rome, do as the Romans do. On that note, Punit, Daksha and Amrish, hold on to your thoughts because it's now time to slip into a short break. Stay tuned to ET Now. We are coming back after a short commercial break. Welcome back to the show. We are discussing some of the important capital market tax policy changes can be expected in Budget 2017, and I have with me a stellar tax panel. Daksha, now let's look at Securities Transaction Tax or STT. STT brings in about 7,000 odd crores to the exchequer. If you look at the current rate structure, it's between 0.017% and 0.125%. Could that possibly be hiked? Because the Prime Minister said that people who make profit from the markets need to pay more taxes, and STT is the fundamental tax that is paid in the securities market. Could that be hiked? Is there a case for it?
It could be hiked, but let me also hasten to add that STT is not paid whether or not you are, it is paid irrespective of whether or not you make the profit. You carry out a transaction and you pay STT. So that is not really related to making profit out of the capital markets. But that said, it is not completely out of place to raise the STT a little bit, because even a 10% hike in STT, given the number that you have given, will raise the rates from 0.0187% to 0.1375%, marginal increase, and it will raise revenue by 700 crores even if the trade levels remain the same. If the trade levels increase, quite a significant collection can be made.
So it might lead to initial disgruntlement, but then the consequent revenue impact is significant.
It's significant. So I wouldn't say that there is not a case for it, but it doesn't really relate to capital markets, people making profit or loss.
Profits. I think gains is the key word.
Yeah.
Puneet, your thoughts in this regard?
If STT is increased, clearly there would be or there should be a corresponding impact on the short-term capital gains tax or long-term capital gains tax, and therefore it comes with strings attached.
So you're saying they cannot be isolated from each other?
Absolutely.
Okay.
Now I am fully aware, I have spoken to several of our clients, and forget taxing long-term capital gains. There is a demand to even abolish short-term capital gains tax and increase STT rate.
That's an ideal regime, Puneet.
Absolutely. No, but it's a real discussion which we had, and it's something which is very serious.
I doubt the PM will be generous in that regard,
especially after the current statement.
Considering his current
but there is a demand on that. I can tell you that.
All right.
And it's very serious demand, especially after 1st April 2017, where the treaties are going away, and therefore there is no, so to say, tax protection to the funds who are investing in India, and therefore there is a case to increase STT but abolish all taxes. That's one case, but as I said, maybe far-fetched, I agree, but clearly if STT is increased a bit, there is a case for a reduction of either tax on short-term capital gains, basically.
Do you think, Amrish, that this could be the least controversial way to up the tax collections without causing too much of a flurry?
I think, yeah, that's true. I think because if you see the way STT has functioned, I think it's an easy collection. I mean, you don't have any administrative cost for that collection. So, vis-a-vis the administrative cost, this is something which, even if they raise it, even let's say 10%, as Daksha was mentioning, it just gives them a straight, upside from a revenue perspective. So I think that's a easy way out, or a low-hanging fruit, as one may want to call it.
Amit, you look at the tax aspect of deals, you've been in the market for several years. So in your experience, what are some of the typical market avenues or routes that are used by both domestic and foreign investors that have been looked at with suspicion by the income tax department, and which could perhaps lead to consequent changes in tax policy in the budget?
See, I don't think, if you look at big investors or the informed investors or the institutional investors, I think what they do on the market, whether it is long term, whether it is short term, I think it's clearly paid for, whether in the form of STT if it is long term, whether it is STT plus short term capital gain. I think the important thing is what we keep on hearing is about some stocks which are suddenly the price rises, and therefore you see a lot of activity and a lot of gain. But this is, I think, some of the things which the Prime Minister must have mentioned when he talked about illegal activities and all of those aspects.
Are there any grey areas relating to market avenues and instruments wherein there's a strong difference of opinion between the department and investors over the years, which has been left untouched so far but could be touched in the budget?
So I think if you look at it again, there was some clarification some time back relating to whether you are a trader in the stock or whether you are an investor in the stock. That's been the biggest one over the years. I mean, over the decades, if one can put it that way. And I think they tried to clear out at least a large part of it. Some still grey areas do remain, but apart from that, I don't think there's a big mismatch on that count at least. The other thing I think as you put down is what can they do. So we've seen in some cases, at least domestic, people wanting to adopt, how do I create a loss from a stock market transaction, and do I have a other gain, and do I offset that against that gain? So that's the other one which through bonus stripping and those type of,
that's pretty rampant.
Rampant. But there, to my mind, today we have a 3-month sort of a cool off period for those type of acquisitions both ways. If they extend it to 6 months, I think it will just make it much more difficult for people, because one must remember whoever is engaging in that is taking a market risk.
Yeah.
So it's not coming without a market risk.
Sure.
So obviously, while there is a gain to be made on the tax side, but you're taking a larger risk.
Okay, point taken. Now let's move on to the last aspect, and that's the aspect of treaties, tax treaties. The PM also spoke about the fact that, his government has cleaned up several treaties, has amended treaties with countries like Mauritius, Singapore, Cyprus, and that has removed the tax advantage that certain foreign institution investors had. Daksha, do you think there is more scope to tighten the treaty route in budget 2017 over and above what has already been done? Because we've seen so many amended treaties now being publicly announced by the Finance Ministry. Is there any other aspect of treaties that could be tweaked by the government in the budget?
First of all, budget cannot tweak anything in the treaty
No, I meant a direction
itself.
at least.
Yes.
A statement.
Direction, a statement can be made. And say, for example, with the India-Mauritius Treaty, what has been taken away from the treaty benefit is merely the capital gains made by equity investors. Okay? So if the investor is investing in debt or in a derivative instrument, all of those are still exempt from capital gains tax in India.
Okay.
And if you look at the markets, what gives the depth to the market, not just equity trades, a lot of it is derivatives and debt instruments. Debt instruments has not yet taken up that much, but a huge amount of derivatives. And that continues to remain tax-free. But also look at it, those are also high risk instruments.
Got it.
Why would people want to take those positions? Because they trust in that economic activity, and that's why they are taking, and that's a fantastic way of bringing money into the capital markets. Now, you could decide to plug it and say we want to tax it, but then it must be weighed against what you're going to be losing.
All right, Daksha, I have 30 seconds. I have to wrap up the show. Punit, your closing thoughts on this before we wrap up proceedings.
I think the answer lies in the BEPS action points, multilateral
erosion and profit
instruments,
shifting.
clearly, and the multilateral instruments where all the countries are going to be signatories, where the treaty renegotiation could be virtually compulsory. If you sign it, you'll have to anyway renegotiate tax treaties with various countries. So treaty shopping could be the days of past, and it has to go away in the current regime. Plus, GAR is kicking in on 1st April 2017, and therefore it's going to become increasingly difficult for the foreign investors to access these measures to reduce their tax liabilities.
All right, Amrish, Punit and Daksha, thanks so much for taking out time and sharing your takeaways just a month or so before the budget. With that, we have come to an end of this special edition, which analyzed some of the major proposals that could in fact be ushered in by Finance Minister Arun Jaitley in Budget 2017 from a capital markets perspective. Hope you enjoyed watching the show. Stay tuned to ET Now for more news and updates.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.